Today I want to take a look at a potential market myth. It's certainly an accepted statement that the market hates uncertainties. But let's take a look at that in a little bit more detail. And I'd like to remind you, if you enjoy these videos, please subscribe to our YouTube channel or click like below. So I'm going to start with the question, does the market hate uncertainty? And yeah, analysts often say that, especially when the market goes down. The idea is we have to explain the decline somehow. Let's just say it's uncertainty. This was especially common in the 2022 plunge as coronavirus weighed on the economy. Shutdowns were unprecedented in scope in many areas, and analysts had no idea basically what would happen. Would there be a recovery that was quick? Would the recovery be protracted? So the decline made sense by just saying the market hates uncertainties. Now, the reality, uncertainty is a constant in the economy and in the markets. Global politics just hangs over everything, creating uncertainty. Elections all around the world affect trade policy. They affect conflicts. So uncertainty is actually a constant. And since it is a constant, it can be quantified to a degree. And a group of economists created the Economic Policy Uncertainty Index. Now, they have developed indexes for around the world, but I'm just going to look at the US-based index. What they do is they look at news articles, and they use 10 large newspaper organizations. Obviously, they go online rather than looking at the hard copy all the time. They also take reports by the Congressional Budget Office and look at the tax code. The tax code is often uncertain, and they quantify that. What are the expiring tax rules, and how will they affect different transactions? And then they look at the Survey of Professional Forecasters, now maintained by the Philadelphia Federal Reserve, and they look at the dispersion of the forecasts, and they combine these three variables into an uncertainty index. This was the original work as defined, and as you can see, they've been able to associate an event with almost every spike in this uncertainty index. And many of these were, in fact, associated with stock market pullbacks. So the idea at first glance could be uncertainty has something to do with it. Now let's look a little deeper at uncertainty. This is going back the last 10 years. And it appears that since 2016, we have the spike after the election, and we reached a higher level of uncertainty than in the past. So uncertainty is a constant, and it seems to be elevated in recent years. Of course, 2020 spiked to new highs, still elevated, and the changes to the tax law adding to the level of uncertainty. And that might be one of the primary factors going forward associated with just the uncertainty of forecasts. The dispersion of forecasts is widening as the money supply grows. And economists are split on just how this stimulus is going to affect the economy. So base levels appear to be in a permanently elevated state. And I know saying they're at a higher plateau is potentially erroneous, but because of the tax code, I do feel like we're in for long-term changes in uncertainty. Now, this is the stock market. And what I did was I took the uncertainty index and I highlighted those times when the uncertainty index was more than 2 times above its 200-day moving average. So these are the times when uncertainty is extremely high in the stock market. And at first glance, it does look like uncertainty is associated with declining markets. Drilling down, looking back at about the last 5 years, we see that uncertainty follows the decline. In other words, the stock market is the driver of the uncertainty. So to say that the market hates uncertainty is kind of not very useful from a trading perspective because the uncertainty follows the decline. Traders become nervous when the market declines. Journalists and economists become nervous and the uncertainty index rises. So it's the stock market that's leading this parade. The market loves uncertainty is certainly a popular saying, and it's almost universally accepted. However, it just doesn't seem to be true. Uncertainty follows a market decline, and that makes sense. We all get nervous after the market sells off. Just as a reminder, if you enjoyed this video, please click like below and subscribe to our channel. Thank you.